Guys, I just came out of this strategy session with one of my clients, and I really would love to shoot this video and share 7 steps on how to cut your taxes in just 10 minutes. This video is all about taxes and how you can stop paying taxes and giving away your hard-earned money and keep it more in your pockets so you can spend more for the things that you really love to and matter most to you. Taxes is one of my favorite subjects, and I have been talking about this and doing taxes for other business owners and individuals for over 26 years. Everyone is thinking that taxes is something that you have to be paying and giving away, and everyone's knowing how to take advantage of the tax law and regulations. You can grow your wealth and accelerate your income in a much faster way. I'm Ella Rivkin, an expert in financial freedom and business growth, working with business owners for over 26 years. And I can guarantee you that I can find up to 100,000 in extra cash hidden in taxes in your bank accounts that you didn't even know that you had in just one strategy session. And if you would like to take advantage of that, then click the link and book the strategy session with me. Want to save big in taxes this year? In today's video, I'm going to share with you 7 proven steps on how to cut your taxes in just 10 minutes. Step number 1, review your financials. Review how much you're making and how much you're spending. It's important because you want to know how much money came in, how much came out, and how much are you expecting to receive in profit. So knowing in advance how much profit you expected to receive, it's going to allow you to know how much taxes are you facing to pay. What you're going to do is you're going to reverse engineer, and then you're going to create a plan. Okay, let me give you an example. So typically, whenever I work with my clients, the first thing what we do is in the beginning of the year, we identified how much gross will come in into the business, how much expenses will come out, and what are we expecting to have in profit. So knowing that number, what we're doing is the next step, we reverse engineering. So let's assume when I was working with one of my clients this year, we identified that he is looking to get in profits like 500,000 a year. So now knowing that number, we know how much he's going to pay in taxes, how much he is facing in liabilities. Now we reverse engineering. Okay, knowing that he has to pay 500,000, what are some of the strategies that we can start utilizing to reduce this tax liability? Then we're putting together a step-by-step plan what we can do, and there's a lot of things that can be done, but we need to know what is the best way specifically for him. And here's another important thing. It's important is to know what is his goal for the next year, 2 years, 3 years. Because when you going to your accountants on like April 1st or April 15th, when the tax return is due, or for those of you that are due in March, then at that point, that's not much that you can do. That means that you are being reactive, not proactive, and you cannot come up with any kind of strategies. So this is why it's very important to know beforehand how much are you facing to have an income and what would be the tax liability. So the second step now is maximizing the deductions. So now that you identified how much are you expecting to receive in profits, let's take a look at all these deductions that you have and what can we maximize on. What are some of the things that we're not deducting and we can take advantage of it. And in this step, I would like to share with you some of the deductions, and if you haven't taken advantage of them, it might be very helpful, and then you can start taking advantage of all these deductions. So there is a lot of different deductions you can do. Make sure that you're optimizing home office deductions. You're taking advantage of accountable plans. Accountable plan is something that allows you to deduct expenses like for the vehicle, for the insurance, for the gas, for the tolls. So basically it's for you as an owner of the company as well as for your employees. Having accountable plan in place in your company, then you can deduct those expenses that are business associated. So let's say if you have a vehicle which you use for the car, and let's say that you lease this vehicle, so then having this accountable plan in place, you can deduct the lease payments, you can deduct the insurance, the tolls, the gas. At the same time, if you're utilizing the home office to work from home, then you can deduct the home office expenses and whatever expenses associated with keeping this home office. The third step is taking advantage of the retirement contribution. So I absolutely love this strategy. I utilize it myself, and I always advise my clients to take advantage of that. And I love the strategy for the number of reasons. The first reason is that you can deduct a lot actually utilizing that strategy. So let me just give you an example. So one of my clients, when we were doing the strategy session, we identified that she was expecting to receive like up to 500,000 in profits at the end of the year. Obviously, it's a lot of taxes to be paid on 500,000. It's like she's in the 50% bracket. And now imagine this, earning 500,000 and giving 250,000 of it to the government. So obviously, one of the strategies that was suggested for her to take advantage is the pension contribution. She was able to take advantage of the defined benefit plan, and since she also had her family members on the payroll, so she was able to take the bigger deduction. So she made a contribution for herself, then for her daughter, at the same time for her husband, and that allowed her to put away towards the pension contribution as much as 400,000. What it meant for her, she was able to save like close to 200,000 in taxes, being in 50% tax bracket. So now imagine, instead of giving this money to Uncle Sam, she actually has this money, and now she can utilize it for, and in fact that's what she did. She took this money, and then she always wanted to buy a property, invest in real estate, and then she took this 200,000 and then she invested as a down payment in the real estate project. She was able to save in taxes, and then at the same time take this money and invest it firmer so she can make more money. Here's another reason why I love pension contributions besides just saving instantly on taxes. And by the way, here's another thing, you're saving instantly. But another reason why I love this strategy is now that she put this 400,000 into this pension account, what next happens is that she is earning money. So typically when you put money into this retirement accounts, you typically put them some kind of financial institution where they're being invested. Typically it's being invested in mutual funds or stocks, and you earn dividends and you earn money on that. She puts this 400,000. Let's assume she makes 10% out of that. So that's 40,000 a year. So since it's in this pension account, in this tax deferred account, now what happens to this 40,000, that she doesn't pay any taxes on that. So the whole 40,000 is being added to this 400,000, and now it allows you to accumulate the wealth much faster. If she wouldn't put this money into this pension retirement account or had it in her brokerage regular account, what would have happened is that she would have paid taxes on this 40,000. If she is in this 50% tax bracket, well, even if not, if it's just the capital gains, it's still paying 20%, meaning out of 40,000, you're giving away 8,000 right away. So you see the difference? So besides saving instantly by putting the money away, whatever you're earning in this account, you're not paying any taxes because they are being deferred. And here's what I want to share with you is the most common way everyone knows and talks about retirement and investments is giving this to these financial institutions and putting them into these mutual funds or the stocks. But it doesn't have to be that way. You can actually manage it yourself, and you can even invest it in the real estate if you want to. So there are certain rules and regulations, so that's called the self-directed IRA, and you can do the self-directed 401ks as well. There's certain rules and regulations, they're very strict, but it is possible to do this. I've been personally doing this for over 15 years, own my own pension. It's in the trust, and I manage the trust, and I invest in real estate and different ventures. As long as you follow these guidelines, it's absolutely possible, and it's the best vehicle to accelerate your growth without paying the taxes because you're deferring them. I would like for you to revisit this strategy because there is another way, and you can take advantage of that as well. Step 4, hire family members. So this is another great strategy that you can utilize, is hiring a family members. So if you in your business, and if you have kids or a spouse or any other family members that can help you, you can hire them and you can pay them. So that provides you numerous amounts of benefits. Well, first of all, paying, and there's more income that comes into your family. And then another advantage is you're saving in taxes. And the third advantage is, besides just saving in taxes, you can actually save even more, because by paying your family members, you can take advantage of the accountable plan, meaning that now you can take deductions, more deductions, whatever pertains pertaining to your family members because they considered you employees. And at the same time, since you have your family members, you can take advantage of putting money towards the pension contributions as well. So as you see, just by utilizing that one strategy, you can take advantage of all the other strategies as well. So let me just share with you one of the case studies. So one of my clients, she is utilizing this strategy. She has her husband who is helping her with the administrative work in the business. So she is paying him, and then by paying him, he is considered to be her employee in the business. Now, the next thing what happens is she's taking advantage of the accountable plan. So he has a car that now she can deduct this car, she can deduct the insurance, all these tolls, parking, the telephone, so like all these expenses that are associated with him working in the business. At the same time, she has her son who is working in the business and helping her with all this social media. So now, since she has her whole family helping her in the business, her son and then her husband, at the same time, besides just taking advantage of the accountable plan, now she's taking advantage of the pension contribution as well. So since they are employee in the business, she can make a contribution towards the pensions account as well. And now she is maximizing even more deductions and saving more of the money in her business. All goes back to her personal accounts. Now, step 5 is full equipment write-off. So let's talk about this. Full equipment write-off, it allows you whenever you purchase an equipment for your business, then you can take advantage and deduct the full cost of it. So what it allows you to do is it allows you to maximize the deductions and reduce your tax liability. So one of my clients, so she is always out there to take advantage of all these new technologies and all these new developments, and she always buys them. This year in particular, she purchased the state-of-the-art new equipment, and it costed something about like 100,000. So what it allows her to do is it allows you to take advantage of this. It's called Section 179. It allows you to take the whole deduction of this equipment. She is writing this off, not paying any taxes on that, and then at the same time, what allows her is to increase her revenue in the business. Now that she purchased this new state-of-the-art equipment, her clients absolutely love all of this. She is right there in the front of the line before everyone else offers the services. She is booked, they all come, and then it allows her to increase her revenue, bring more cash in the business, and then at the same time to maximize her deduction. It doesn't matter throughout the year when you purchase this equipment. Even if you purchase this equipment towards the end of the year, like in December 20th, as long as you put it into the use right away, then you can still deduct the whole cost for the whole year. Step 6 is prepaying expenses for the cash basis businesses. So what does it mean? Let me explain to you. So typically, when you have a business, you have a corporation, or if it's an LLC, sole proprietorship, then at the end of the year, and for everyone the year ends differently. So let's say if you're an LLC, S Corp, or sole proprietorship, then the year ends for you December 31st. If your corporation is on a fiscal basis, then the year might end in January, February. What means is that at the end of the year, let's say if the year ends on December 31st, it's whatever cash left on your bank account that is considered as your income. So let's say if on December 31st you have 100,000 cash left on your bank account, that whole 100,000 will be considered as your income, meaning that you will have to pay taxes on that. And then at the same time, there's other factors involved. If you took distributions throughout the year, that will be considered as your income, or what other money you took throughout the year, but that's not the point. The point is, it's knowing how much cash you have left in your bank account. If you are in the fiscal year, let's say the year ends for you March 31st, just giving you an example, then whatever cash left on that date, March 31st, will be considered your income. So what's important to know is, when does your tax year ends? If you don't know that, then I would suggest for you to ask your accountants or to look at your tax returns, because this is very important, and you definitely want to know the date when your year ends. The next step is to prepay these expenses that I'm talking about. So if you're in the cash basis, if you, in that case, I was telling you, like, let's say you have 100,000 left on your bank account. Now the goal is to reduce that amount. So this way you'll pay less taxes and you'll save more money. So now what I would suggest, and typically this is what I do when I work with my clients, is, okay, let's identify, like, if you have insurance bill that needs to be paid in a few weeks. So if you have some vendors that you need to pay. So basically you identify who do you need to pay within the next few weeks, within the next month, so you can pay it right away, meaning that then you can reduce your cash balance, and by that you're reducing your tax liability. So this is one of the great strategies to use if you're in the cash basis. And at the same time also you can do the same thing, paying employees, paying your vendors, paying the credit card bills. Typically the credit card bills, you have like this grace period to pay. I think it's just one of these great strategies to utilize and for you to know when the year ends, so you can monitor the cash at the end of the year to reduce your tax liability. And lastly, step 7, get expert advice. So if you're one of those taxpayers who hates taxes and waits till the end of the tax year whenever the tax returns are due and going to your accountants, then I would suggest for you not to do this and to get an expert advice. As I mentioned already in the beginning in step 1, it's very important to know how much are you expecting to make in income. And then based on that, you will know how much you expected to pay in taxes, so you can reduce your tax liability and not wait till the end of the tax year. Here's another thing, having the right advisory team, consulting with the expert, you can significantly lower your tax liability. Let me actually share with you this recent case study. In fact, it just happened 2 days ago. One of the clients, he's not even a business owner, he wants to open a business, that's why he booked a strategy session. So typically the way that we work is we don't just, like many accountants out there, okay, if someone just wants to open a business, typically they just, okay, come, just take the money, open the business, I'll see you when the tax returns is due. So typically the way that we work is first we identify what are your goals, like what is your intention, where would you like to see yourself, like in a year, in 3 years, in 5 years, and then discover like what's important to you, what's going on in your business. And then originally when he came to us, he said, okay, I want to open an LLC. We say, okay, what is the reason why you want to open an LLC? Well, his reason was because his friend told him. Is your friend accountant? Is he an expert? No, it's just because this is what he has, this is what then he told me to do it, and then he decides he wants to do that too. But is this smart to ask your friend? Here's the thing, most of us, this is what exactly we do. We ask our friends, we ask our co-workers, our relatives, then whatever they tell us, we use this advice and then we go and use it. It might be great advice for them, but it doesn't mean that's a great advice for me. So, and that's exactly what happened with this person. So then we started asking him more questions in terms of, okay, like what type of business he wants to do. And then we asked to review his tax return that he did last year. So once we received his tax return, what we identified is that first of all, he didn't even need an LLC. He just needs a regular corporation. Second of all, by reviewing his tax return, we found out that he overpaid close to $10,000 in taxes. He wasn't even a business owner. It's just a simple W-2. He's in the construction. He's making like $120,000. His wife just a home attendant. She's making $40,000. It's only $100,000 a year. And he tells me, well, we don't have any deductions there. It's a simple tax return. So we thought that anyone can just do it. A lot of people think that way. But what turned out is when I reviewed his tax return and I showed to him that he could have saved $10,000 in taxes versus actually paying $4,000 to the government. And here's another thing, that now besides paying this $4,000 to the government, because he didn't have this $4,000, he put himself on the payment plan to pay it for the next 2 years, meaning this $4,000 is going to turn out to be like 4.5 or maybe even 5,000. So you see, it's just a simple person, not even having a business, already lost $10,000 to the government. Now imagine if you're making in your business hundreds of thousands, or some of you millions of dollars in the business in gross revenue, then how much money are you losing and giving to the government? So that's why it's very important to ask experts. So as you can see, in just this simple story, a simple person, and we found this extra $10,000. So you can always always find this hidden cash in your businesses, even if you don't think about it. It is there. So it doesn't matter what size of the business that you are in. You can always find this extra cash hidden in your bank accounts, and I can help you with that. Click the link below and book the strategy session with me, and I would be happy to help you find this money that you didn't even know that you had. Thank you for watching, and if you found this video helpful, then please subscribe to my channel to accelerate the journey to your financial freedom. And remember guys, financial freedom is all in your hands. I'll see you in my next video.